Welcome to Tradiers, the Trader's Edge. I'm Jim Iuorio. That's Bob Iaccino. We are, what's that echo? Is that you?
That is the bell.
That's what bell? We
Closing bell.
Stock market.
Closing
Oh,
bell.
the stock market. Okay, good. I hope we wasn't saying the round was beginning. Right? Anywho, please also join us at the Unfiltered Investor, myself, Bobby, and Mike Arnold. We take some of the topics we talk about on the Tradier platform and drill down into them with some actionable portfolio construction type thesis. You guys will love it. Bobby, today's NVIDIA. What do you got?
Don't have it yet. I'm not seeing any movement in the stock. That's part of why you heard the bells, because I've got my actual trading platform up to be able to hopefully give you something on that.
So this is going to be exciting. We're going to be like real news people. We're going to be breaking news. NVIDIA.
Yeah, it's just I've seen people do that poorly, and I think we would fall under that classification of doing it poorly. So
we do everything kind of poorly, like whatever.
Yeah, we do our best, which is not good enough most of the time.
Something that was really interesting that we just talked about on the rundown, on the Tradier rundown, that I'd like.
No, I just got an alert there, due out at 4:20.
4:20. Oh, good. Blaze it up. Before we get to Vince, the guest, what about this India thing? We talked about it on the rundown today. Do you think it is a interesting, monumental step that Trump is now using tariffs as a means of punishment instead of for trade goals?
Boy, that's interesting. Monumental. I wouldn't have used monumental, but I do think it actually matters. I don't necessarily think this particular tariff matters, but if tariffs are going to become a punitive thing, I believe they become more biting, because I don't understand the process of him taking them off at this point, as we talked about in the rundown. Whereas the other tariffs, it was just like, they'll come to him. They'll say, I want to make a deal. They'll lessen the tariffs. They'll say they agreed to a deal. He'll take some of the tariffs off. The other country will take all the tariffs off. That's what's happening with the EU right now. But punitive tariffs, I don't know how to manage those in my mind.
Is your gut tell you that he will be successful in driving behaviors around the globe based on threatening with the power of being able to tap into U.S. commerce?
Probably. I think he probably will.
It's
not a bet I'm making. Well, I guess it is a bet I'm making because I'm long stocks, but
exactly.
I do think he'll be successful in it. I can't really tell you why, though. It's just sort of Trumponomics.
Nice. We have a guest we're going to bring in now, someone I'm very excited about. He is the founder and the chief strategist at View Right Advisors. And yes, he has an Italian last name. And by the way, before I bring him on real quick, his name is Vincent Randazzo, which I think is a fun name to say. But already Bobby was calling him Vinny because we're trading floor guys. And his response was, yeah, Vince is good too. So we'll see how this plays out. But let's bring in Vince Randazzo. Okay, he can't be the first guy that ever called you Vinny, right?
No. That's just part of life as a Vincent. You have so many names, you can't even keep track of them all.
Right? Are you Vincenzo?
No, I'm a Vincent, not a Vincenzo. Yeah.
My father was Vincenzo, and you know who? Are you familiar with Chicago mob lore at all, or no?
A little bit.
My father was named after Vincenzo. Was the first mob boss in Chicago, Bobby Colosimo. Big Jim, his street name was Big Jim Colosimo. But my dad had the name Vincenzo, and everybody called him Jim. His story for his whole life was that in his town, in the west side of Chicago, there was this mob boss, and his name was Vincenzo, but his family didn't want him to think he was named after him, so they called him Jim and kept Vincenzo secret. And then I find out like 50 years later that the mob boss's nickname was Jim as well. So that was I was like, Dad, you were named after the mob boss, correct? But whatever. Yeah, Vincenzo Colosimo. That's who Johnny Torrio and Al Capone hit to take it over, because he didn't want to get into the booze game during Prohibition, and those guys did. We should do a whole show on the history of Chicago Mafia too. Where are you from, Vince?
I'm from northern New Jersey, Morris County.
Very cool. Good. And how long have you been in the game?
So I've been at this since 2002. So it's been quite a while.
Very nice. Tell me, before we get to the market stuff, tell me your, like, not your resume, but like you went to school where, why'd you get into this business for? And then we'll get into the market stuff.
Yeah, absolutely. So, I mean, just to like personal stuff. So I grew up in New Jersey. I was actually an Eagle Scout, oldest of four. And that taught me that, you've got to be a leader, and you've got to think smart. right? Um, and also with the scouting stuff, it's taught me to be prepared, which kind of flows into what we're going to talk about today is risk, right? And that sort of shaped my career, especially coming out in 2002. I started at Morgan Stanley, equity research sales. And again, coming out in 2002 with the bear market well underway, I was very sort of attuned to that and shaped by that. And then, of course, we didn't make new highs until 2013, right? So,
it's amazing
that was a part of my career.
Yeah,
right?
It's crazy. Yeah. Bobby?
Yeah, it's crazy because we're starting to talk to people who are younger and younger, Vinny, and we're talking to people who weren't around for that.
Right.
And it's crazy because the biggest thing to them was the financial crisis. And then there's even people involved in our business now where the biggest thing to them was COVID, right? They're just getting started. And there's all these experiences we have, to your point about risk, where one of the things that bothers me the most about the markets right now are these zero DTEs, right? Zero data expiration options. And then that bleeds into my whole point that most people who take on sort of an active trading role, they just pull numbers out of their ass. I want to buy 50 shares of this. Why 50? I don't know. I mean, it's a nice round number. I'm going to risk $5. Why $5? Right? You look at a stock like, I don't know, pick one, Tesla. $5 is nothing. I mean, it could move $5 in an hour and then move back that same $5. Why $5? I don't know. It's even. So how do you approach that kind of thing? Obviously, you're not like a person who educates people on active trading, but how do you approach the risk side of things from that perspective? You don't just pull shit out of your ass. I know you don't.
No, I don't. So I'm more of a big picture risk management approach. So I believe in adaptive equity risk management. The problem with most, risk management framework is that either it basically doesn't exist or it's static, right? So, and most people just do it through allocation. Here's my allocation to equities, here's my allocation to bonds, and that's called diversification. Therefore, I'm good. But cycles have a way of moving those things around and making them really not matter. So my approach is basically to say, okay, use my edge, which is technical analysis and specifically breadth analysis, and find a way to make an adaptive equity risk management system. So that's what I did.
I love that. So can you tell
real quick? We got beats on Five Below and NetApp, but NetApp is down. Five Below's up about 4.3%.
So those are the appetizers, but they're small.
Those are the appetizers.
Yeah.
We actually had 17 total companies with over $1 billion in market cap reporting today.
And nobody cares.
We're only thinking of one because NVIDIA is 10% of the NASDAQ 100, 8% of the S&P.
It's crazy. Yeah. And I have it, and I've owned it. And you know why I bought it? You know why? Because Nancy Pelosi bought it. Yeah, it was a joke when I bought it. I've had it for like 5 years. But anywho, can you dig down? Most people think of risk management, like you said, as diversification. I just recently back tested a portfolio that was 25% SPY, 25% AGG bonds for people who don't know, 25% IYR, which is real estate, and 25% GLD, gold. And the reason I chose those, Bobby knows, is because our friend Jared Dillian has back tested for 75 years a portfolio that has some similarities to that. But I want to say, what I found out was that it averaged over 8% per year, and the biggest drawdown per year was 16%. That to me seemed like a cool, relatively riskless portfolio that, not riskless, obviously, that beats inflation. What are your tools?
So what I do is I look at, like I said, stock market breadth. And what I do is I identify major market turning points. My goal is really just to give advisors a systematic way to navigate market cycles, because most of them just don't have the time or a process of their own to do it. So what I'm trying to do is avoid the big drawdowns. So I'm not talking about like pullbacks. I'm talking about like major market tops. And that's what my later part of my career was really about, is identifying some of those major markers and figuring out, okay, how to basically react to it, in a proactive way, so that it's not too late. I think that's a lot of trend following systems have that problem, right? Where like, yeah, you're risk adaptive, but it's often too late. It's sort of after the fact. And my approach, because it's based on breadth, which is just stock participation, how many stocks are going up versus how many stocks are going down. It gives you an early heads up, an early warning that, okay, market's fragile here, risk is going to come on. Here's how we adapt.
So aren't we in a spot now where participation is just too narrow when you look at the breadth, when you look at the top 10, whatever we'll call them?
So I think so. This environment is really interesting, right? So I would say that breadth in terms of just how many stocks are going up versus how many stocks are going down is actually okay. The issue though is attribution, because those names are so big at the top. It sort of gives people the idea that that's all that's going up, because they really are moving the market, right? Because they're just so big in the indexes. And that's part of the other reason why I do what I do, because with breadth, every stock gets a vote, and I think of breadth as liquidity. And this is how I talk to fundamental guys about it so that they actually listen to me, is that, how much money going into how many stocks is a measure of liquidity, right? The stronger the breadth, the more money is going to more stocks, the better off you are as a stock picker or for any other reason to be in the market. So if you know that, then you basically know, okay, I'm pretty good here. And right now, that's actually, believe it or not, that's where we got. That's
Well,
where we're
I
at.
like what you're saying, because I'm big into the liquidity trade. That's been how I've made a lot of money over the last few years, just to try to gauge liquidity being injected into the market and where it's going to show up. And there's a lot of different anecdotal things that I look at, but seems like it's much more quantitative. Bob?
Yes. Let me ask you, I had a friend who despises the president. And when he got elected and he talked about how he was going to do the tariffs, he sold out of all stocks. Right. And April 2nd, he said to me, he goes, if I had more to sell right now, I would. And then I found out later on, he actually sold on April 2nd. He was just full of shit that he sold earlier than that. How do you obviously have clients that you speak to, institutional or otherwise.
Yep.
How do you get them to the point where you're like, look, you don't act on events like this. That's not what you do. Okay, we have a framework, we have a structure. How do you convince them that? Is it just all data? Or do you look at them and say, look, you're doing something emotional, and by definition, that's wrong?
Right. I think it's a matter of appealing to that sense of logic, and also that we've been here before and we've learned and we look at the data. So, and I'll give you an example of that. So one of the big pieces of my puzzle is breadth divergences. And what that just means is that there are fewer stocks going up than are going down, but the index is still going up because of what we just said, right? About those weighting issues and the way that the indexes are designed. So that is inherently a reflection of human emotion right there, that divergence, because what it tells me is that you have a simultaneous fear of loss and a simultaneous fear of missing out, right? And what I mean by that is, what you're doing, in essence, you're crowding into these big safe names, right? And when you do that, breadth gets weaker, which means the market gets more fragile. But, being humans as we are greedy and we don't want to miss out on any gains. So we're just kind of holding it to the last minute. And then it becomes like a game of musical chairs as far as liquidity goes, right? Where there's just less and less places where you can reliably put that money, because there's only a few stocks that are working at that point. So that's what I try to explain them to that. And this is a historical phenomenon. You can go back 100 years, which is what I've done. And this is how it is. You have these conditions that lead to big drawdowns. So what I did was I put a framework around in thresholds and sort of just put some math to it and say, okay, well, when are these things really dangerous to the point where we need to act to them? Because we know that through history, you can have really long divergences and they might not mean anything. Right. Just like a long inversion of the yield curve might not mean anything until it does, right? So that just putting those triggers after that condition, because what I'm talking about is just a condition, right? So I want to identify what's my actual trigger. And then we can sort of isolate that and say, okay, well, this process is based on human emotion, so it's not going to change. And it's based on numbers and breadth, which, of all the indicators I've ever studied as a technician, are the only indicators that have never really led me astray, because you can't fool them. They're just too simple.
Right.
By the way, so talk to me like I'm a 5-year-old, because when it comes to market breadth, I am a 5-year-old. It's something, I've been a futures trader for forever. So, and I trade equities all the time too, but mostly technical. Can you walk me through like just a 101 on watching market breadth, where you go, what do you look for, et cetera?
Sure. Yeah, I'll tell you some of the indicators that I watch. So I love the New York Stock Exchange advanced decline line. I mean, I just think it's so simple. It's just a long addition problem.
The best one to me. Yeah.
Yeah, I mean,
you said the same thing, Bobby. I didn't hear what you said. Same thing.
I said, yeah, that's the best one to me.
Okay.
Yeah, I mean,
what
it's
do
a
you
long
look for in it?
It's a long addition problem. That's all it is. So mathematically, if you think about what a divergence is, it just means that there are like more than 50% of stocks are going to go down on any given day for that number to actually go down, right? Again, it's just addition. And there's no interference. And that's what I love about it too. There's no human interference. It's like,
Bobby, is there a chance that we could put up the advanced decline line and it can talk to the chart?
Yeah.
If you work on that. You keep going, Vince. I didn't want to interrupt you, but I like it. Yeah.
Yeah. And then other sort of plain mathematical items that I like to look at, new highs, and I give you an example of new highs. I looked at every major market top through history, and the common trait that number has with the actual top peak day of the market. Everybody thinks that that's a crazy high number. A lot of stocks hitting new highs on that day. Reality tells us, the numbers tell us, history tells us that there's usually around like 5 or 6% of stocks making new highs on the day of the last all-time high.
Wow.
For a bull cycle.
Okay.
Right.
Yeah.
And then if you take another number I like to look at, which is the percentage of stocks above their 200-day, 100-day, and 50-day moving averages. Let's just take the 200-day moving average. This is a rough estimation of a long-term trend. So how many stocks, what percentage of stocks do you think should be in long-term uptrends on the final day of an all-time high? Raging bull market. Everything looks great. Final high.
So I would say over 50%, right?
It should be a lot higher than that, right? It should be a ton higher. In a healthy bull market, and in fact, you're right. In a healthy bull market, it should be about 70, 75%. But at every major market top, that number averages right in the mid 50s. Again, almost half of stocks are in downtrends by that point.
Okay, what you're saying. Okay, this is fascinating to me.
Right, and this is stuff that's counterintuitive. Again, people think, oh, new highs, like it's been a raging bull market for a long time. It's a party, it's a blow off top, whatever it is. Look, under the surface, if you're looking at this breadth stuff under the surface, this is what you see. You see sort of a hollowed out market that's really vulnerable. And that's why I do what I do. And I don't just look at price.
And I can get, okay. So if I wanted to start looking at this, which believe me, I will, is there data that I can get that says the amount of stocks in the S&P 500 that are trading above their 50-day moving average, above their 200-day moving average, et cetera? How do I get that? Yeah,
there's a ton of platforms out there. I like Optima. I use their data. They have those metrics on a lot of different indices, whether it's the New York Stock Exchange composite itself, whether it's the Russell 3000, NASDAQ. I would caution against using NASDAQ because it has a sort of permanent downward bias because there's just so many, I won't say, crappy companies, but smaller cap companies that have a downward bias to them. They're generally going to sort of fade out of existence at some point.
No, that's valuable. Oh, what you just had up, Bobby, was just the Qs, right?
Yeah, it's the SPY.
Yeah. Okay.
And the bottom is the advanced decline line. I don't usually like to use it.
Okay, good. Can you get more data? Can we go back like 10 years or anything?
Yeah, I mean, I could scrunch it up for you. This again is just rough. This is on a TradingView platform. It's not the way that I use it, but it kind of, gives you an idea what it looks like. What do you
see that can illustrate? Because this, by the way, I'm blown away. Like I said, this is an indicator I've never used, and you're making a convincing argument that it's something kind of cool. What do you see here that's interesting?
So this is not the way I would look at it. This is daily advancers versus decliners.
Right.
What I'm looking at is like a cumulative line. So it's just like if you took those bars at the bottom, you just added them all up. That's the line I'm talking about. And I could just tell you guys, just for the sake of this picture that we have up, that in late November is when the AD line hit its all-time high. But yet the indices made new all-time highs in February, right? So that's what I'm talking about. That's the divergence. That's the hollow point of vulnerability that you look at and you say, oh, that's a disconnect.
Okay. By the way, we have 30 seconds to very breaking news, and we're going to pretend like we're real live journalists here. Vince, we'd like for you to help us. Okay. Are you going to put up an NVIDIA chart, Bobby? Oh, Bobby's gone. This is like a dream come true to me. Then I can just talk without any interruption. See, Bob, I'm going to get my NVIDIA chart up here. Hopefully he's working on getting it up. So let's see what happened. Right now, going into the stretch, we have NVIDIA is just up 0.5%. So I assume nothing's come out yet.
Nope, nothing yet.
Nothing yet. So we keep talking or you want to wait for it, Bob? Your call. You're the boss.
It might actually, we can keep talking. It might actually be in our chat before
Something just happened. It just jumped a buck. Nah, probably not.
I got a couple of questions or comments really quick that I want to talk about while we're waiting on this. Widge says, after 2002, we thought we saw the worst of it all and that we just saw the 100-year event and we were in the clear. And then,
silly us, Widge.
Yeah, Widge is great. And then Tim puts, speaking of liquidity, the reverse repo facility has gone from 2.55 trillion at year-end 2022 to 47 billion today.
I look at it every day, Timmy. Yeah.
Yeah. Does this cause any concern for the market? Jim, you want to tackle that and I'll interrupt you?
To me. The other liquidity indicators that I'm looking at are behaved. Things like, M2 money supply continues to go higher. Credit spreads still are narrow as shit. So the reverse repo is one of my clues as to when the music could be stopping, but it's not enough to do it on my own. It's not enough to do it on its own, is my opinion on that. Do you have any opinion on that, Vince, or is that different than what you look at?
Yeah, it's just a different angle, right? I mean, I think that, the things that I look at will be fed by all that data. Like I call that the smart guy data. I'm just looking at the sort of core of the equation.
Okay, quick timeout. NVIDIA's getting hit right now, down $8, which is about 4.5%. Now up $1, now down $8 again. You know what? That print must have been wrong, or somebody just had a terrible trade when liquidity vaporized and it went from down 8% to up 1% in a blink. So, okay, let's move right along.
Mm-hmm.
Bobby?
Yeah, I've lost my my attention span here as I'm looking for it. If anybody has in the chat, looks like NVIDIA's down quite a bit right now.
Yeah, now it's down quite a bit. It's down over 5% now.
Yeah, I'm looking at it at about 172 and change in the post market. So looks like they must have missed something, which is not good for some of the stocks I hold. But this is kind of one of those things where that Vince is kind of talking about. You have an event. Here's an event in a single stock, and we obviously don't have markets open, but we've got the futures open, right?
Yep.
Which you don't really talk about a lot on here. And I'm not seeing the NASDAQ get hit as of yet. Is it still
down
open?
Down 0.5%, right? You might not have live on what you're looking at because I have it down 0.5%.
Yeah, down 0.5%. And it was kind of in the cash close. It was up about 1/4% or so.
So right. So let's call it down 1%. Yeah.
This kind of an event doesn't really affect the bigger picture. When I'm talking about the bigger picture events, are we talking about quarterly for you, annual for you, or how often do you sort of reassess things and say, we got to make a change?
Oh, I think he's frozen.
Looks like he might be frozen.
Okay. So Bobby, I want to tell you about a trade I put on today while he's dialing back in. Oh, there he is.
He's just, honestly, it's weird. Data center. You must be near a New Jersey data center. Right during the NVIDIA earnings.
I'm in Florida now. Yeah.
You're in Florida?
Yeah.
Where do you live?
I live in Jupiter.
Oh, that's right. You're in Jupiter. You're from New Jersey. You told me that before.
I fled about 9 years ago.
Good for that.
You have a wife and kids in the full everything?
I do. Yeah. Yeah. I got a wife and 2 young kids. I got a 10-year-old boy and a 7-year-old girl, and we just got a puppy. So everything is pretty crazy around here.
You're doing it all correct. Bobby, I put on a trade today that I wanted to bounce off you. Okay. So I went out to December. Vince, do you use, I keep wanting to call you Nick Rendazzo. It just, to me, it seems like it rolls off the tongue. Hey, no, Vince Rendazzo. Do you use options, by the way, to hedge portfolios at all?
I don't personally, but it's a strategy that, we would sort of recommend for some people who don't want to deal with the tax implication of kind of getting out of the way. Yeah.
Right. So Bobby, I took a ton of duration, like all the way out to December. And this is in the S&P, like for every 2 of the 610 calls I sold, I'd buy 5 of the 580 calls and then sell 2 of, I think they were the 550 calls. So it was buying 4 total, selling 4 total, but being long 5 in the middle. You know what I mean? So if everything craps out. And the fact that here's what my thinking was, is that if things crap out like a month from now, I still have 2 months left on these. So all of them are going to I'm not going to get just hammered on the ones that I'm short at 610. Do you think that's a decent trade? I paid up for it. I paid, $300 for each one, which is 2 by 5 by 2.
I got to be honest, from that description, I have no idea what you're fucking talking about.
Okay, good. Let's move. Moving right along.
Yeah, I just don't know.
Right?
So Vince, where do you fall in terms of, do you prepare for anything like Liberation Day, anything like punitive tariffs, anything like that? Do you prepare for that kind of thing, or is that just out completely?
Yeah, I mean, my view on the market is that the market is just so much smarter than I am, right? So I'm looking to the market to tell me what to do, not the other way around. So my assumption is that I've got, millions of people who are sort of better at this than I am as far as knowing those data points, and they're incorporating it into their thinking, which is incorporated into the market, which is incorporated into the breadth data that I look at. That's just raw data, right? So I'm just looking at the source equation and I'm saying, what does this look like? What's this telling me? So for example, our service got defensive in late February as a result, right? And it had nothing to do with Liberation Day and nothing to do with anything, because that stuff hadn't happened yet, right? Mm-hmm. It's just talking about breadth. It was just talking about a moment of fragility and saying, okay, the conditions are right and the trigger has been hit for some downside here, and we need to be aware of that. So I think if you could avoid those big drawdowns, then you're so far ahead of the game.
So what is the signal that, let's say, okay, you reposition when you saw the advanced decline line and the breadth give you the signals that you got. What then all of a sudden, how much did we get hit in April? Did we get hit about 18% in the S&Ps, maybe something like that? Does that sound right? I have a short memory, but anyway.
Yeah, so 19%. Yep.
Yeah, all of a sudden we get clobbered. What is your signal to then reallocate?
Yeah, it's sort of another. It's sort of the inverse of what I do on the divergences. It's basically saying, okay, with this sort of period of basing and then a rejuvenation of demand that you would see in breadth and you'd see in momentum. So it's all very much process driven. And
so you're not ever going to be picking dead lows. That's not your style. You want to see everything gather itself, and you might miss the first few percentages of the move higher, and then all of a sudden the picture will look a little better to you. That's correct.
Exactly. And then it's going to be high conviction. And that's what I love about the way I built this system, that, you've got hurdles to get out of the market. So we understand that the market goes up 75% of the time, but there's the 25% of the time that it doesn't.
Yeah.
So we just want to avoid that 25% if we can. If we have a predictable process for doing that, which is what we built, then we are so far ahead of the equation when it comes to compounding, and this is something I like to kind of bring back to advisors with this point, is that, okay, that the long-term assumption is a 9% return for the S&P, right? Okay. Well, three numbers that average to 9% are 999, right? Okay.
Also,
three numbers that average to 9.
100, negative 109. Right?
minus 30, 27, and 30.
Right. I meant,
right?
Right.
But the difference is that the difference between those two things is a 30% return and a 15% return.
Yeah.
Right. So it's a huge difference. So then extrapolate that over 30 years of your retirement savings or investing or whatever. You can see how far off the textbooks are when they say, "Oh, you get 9% a year."
Yeah,
it's like
it's burying the lead. Yeah, exactly.
It has a lot to do with when you're done, doesn't it?
That's exactly it.
I know people personally that, they're like, yeah, I got, this is before the financial crisis, right? That said, yeah, I'm good. I got about $8 million. I'm solid. I'm not worried about it. I'm still in stocks. Sure enough, a year and a half later, it's like, damn it, I've got like 1.5 million. It's not enough to retire. I got to keep working. I got to go back in the market because they were just in that position where the paper money was their money to them. Yeah. So do you incorporate any sort of, okay, we've made this much, let's move it out?
No, because that would be interfering with the data. It's just because that would be me arbitrarily saying, well, we're up 50%, so therefore we're out. It's like, well, how did I pick that number? It doesn't make any sense. I just let the market tell me when is it time. The market tells me when it's time. I listen. That's all I do.
I'll tell you
we
where
take a
that
quick
comment
timeout?
comes from. I'll tell you where that comment comes from.
Yeah.
When I was on the trading floor, right? When they finally allowed us, I was up at a desk and they finally changed the rule to where the desk guys could trade. And I put I don't do this now, so it's okay to say it. I put $30,000 in a trading account, and anytime I doubled it, I took 30,000 out and kept going with and put it into stocks, but just longer term investments, right? Longer term stuff. So that's where that question comes from. Is for me, when I reached a certain level, I left it. If I went under 30,000, I didn't put more money in. I just sort of reduced my size and waited till I build it back up.
Kept fighting.
So talk to us a little bit about how much more
Bobby,
important
I need to take a timeout real quick. Luis,
Yeah,
can
go
you
ahead.
put the banner up? Remember, we do that 30 minutes in.
Yeah, you're right.
Banner up. By the way, you guys, this is our favorite show to do. We love the live component of it. And you guys, the participation we get is fantastic. We'd like to ask a favor to you, and that is to, for free, try Tradier Pro, their options trading and analysis platform. We talk to traders who have been trading options for forever and novices, and all of them share the same thing, is that the Tradier platform is absolutely top-notch, the best. All you have to do is scan that QR code, and you will get it for free for 3 months. That's Tradier Pro. Back to your question, Robert.
Yeah. So what I was going to finish that with was, if you could, Vince, go into how much more important it is to manage your losses than it is to actually gain on a particular trade or a particular position.
Yeah, I mean, you guys know this, having the experience that you do, but managing your losses. If you look at all the greats, whether it's Tudor or Druckenmiller or Stevie Cohen, whoever it is, it's the first rule is always don't lose money. That's always the first rule in all these guys' playbooks, and I think it's for that reason. You look at the math equation is why you get that answer, is because you look at that math equation that I just sort of shared with you. And like you said, Bobby, it really depends on kind of where you are in your own sort of retirement plan. And also, and this is something that I think people sort of neglect, is where we are within a secular bull or bear market, right? Because if we're, let's say, getting toward the end of a secular bull market, and at the same time you're getting close to retirement, well, then you're going to really want to avoid any drawdown, at all, because sequence of return risk is a real thing. When you take those losses really matters. So we need to minimize those drawdowns and eliminate the major ones, because those things, they break your retirement plan, just like you shared. And I have friends like that too, in that same time frame at Name Your Bank. Because these are the people who I was in touch with at the time and in my career.
Yep.
And tons of stories like that where they just guy's about to retire, 55, whatever, thinks he made it, and then wow, I got to work another 10 years. 10 years.
When was the bottom? Was it 2007, 2008? When did we?
March 09.
March 09. Because I was sitting with, you guys know Mike Coe from CNBC.
Yep.
He's really a genuinely bright guy, and he wants to be on the show too, Bobby. And I remember he was telling a story that his buddy had just told him. We were sitting in the green room at CNBC, and he was telling a story that he had one guy who was a wealth advisor who kept getting calls for retirees, knowing that this was the worst absolute time to sell, but they couldn't take one more dollar of losses or else their entire everything they'd worked for was gone. So they were selling out. And I remember that day taking off my downside hedges because of that. And to me, it was kind of the equivalent of the Joe Kennedy story on the upside, where the shoe shine boy had, all his money in stocks. I mean, it seemed like the panic was definitely there, but that's not the question. The question is this: we've talked about equities. Now you're talking mostly about indexes. So if your breadth statistics say to you that a top is in, are you selling individual stocks? Are you selling out of some of your allocation to the indexes? Is that it? And do you have allocations to anything else more specific than just the indexes?
Yeah, so what I've created is something that you can apply as an overlay to anything that's correlated to the U.S. equity market. And the beauty of that is that, as we know, toward tops and bottoms, the correlations go like this, right?
Yep.
So to me, yeah, you could apply that. You could apply my work to pretty much anything. And we're giving quantifiable signals. We're saying sell a third, sell a third, sell a third, right? And it's all proofs every single time. It's not, it's only just, hey, these conditions are met. Here's the expected return and versus risk environment that we're in based on history. And here's what we're doing as a result of that. So it's just identifying vis-a-vis breadth, what is the expected return and risk profile look like now?
Yeah. That's interesting. I'm going to ask you guys a question because at the restaurant I own, a lot of older people go, and oftentimes I'll be asked by some of the patrons to sit down with them and look over their portfolio just to get a second set of eyes on it. Which, by the way, one thing I'll mention too is that I'm in contact with their advisors too, and not only do they not feel like you're stepping on toes, it seems like they like other set of eyes on it. So I meet this lady yesterday, nice lady, 70 years old, has been a widow for 10 years. She looks like she's about 45 years old, so my guess is she's going to live to 100. And she had a portfolio of $5 million at a wealth advisor that was 100% in bonds. Now, what I said to her is that your guy probably looked at this portfolio and said, you already won the game. Why take any risk? Mm-hmm. That's a reasonable take. It's just something that I disagree with completely because you could live to 100. You want to leave some money to your kids. She was somewhat of a risk mitigator. Before I tell you what I told her, what would you tell her, Vince?
I would tell her that you don't want to be static in any of your allocations, because the market's not static. It's totally dynamic, and you want to be making the most out of what you can, but doing it safely, but not taking it too far in one direction or the other direction. Right. So, I think finding a happy medium, of course, like I wouldn't know what that is for her, but certainly with the environment, what it is right now, you can say, hey, listen, you could be in equities, a little bit in equities, and it's going to be all right.
So here's what I said, and I couch this with, this is what I would do in your situation. Not telling you, but when you talk with your advisor, I said, and Bobby, I want your opinion on this too. I said, I don't think you should take a tremendous amount of risk. Keep 65 or 70% in bonds because you have won the game. But right. I think you should have about a 30% allocation to riskier assets that could provide better in the long term. But you don't want to buy them all tomorrow. So I said, talk to your guy about scaling it in to achieve that position over the next year where you are then 65% bonds, 35% equities, and then you are still winning. The 65% in the bonds is still going to be relatively stable, particularly if they're the short end and they're paying you, 4% right now. Bobby, do you like that strategy or no?
How old was she?
70. But she looks
70's young now. Honestly,
it is. She showed me the portfolio. I just looked up at her and said, "Will you marry me?" Which she thought was funny. And she's like, you're already married. Oh yeah, right. I'm already married.
Yeah, no, it's just 70 still relatively young, and people need to take that into consideration as well.
By the way, she had at least that much money in real estate or in several different locations as well. That was that her and her husband had as well. Yeah. So,
and Vince, you can jump in. First, I want to put up a post that I highlighted here just because he's a friend of all of ours. Good old Kenny, don't call me Ken Polcari.
Yes.
NVIDIA misses ever so slightly on data center revenue, but kills it everywhere else, and they take it down 4.2%. Whatever. So I guess we know which way he was on this one, at least in terms of his
whatever. Huh. Is Bobby gone again? Okay, so what else? What about things like allocations to gold, inflation hedges, Bitcoin? Do you believe in this stuff?
I do. I mean, I think that there's also a time for those assets to work well, and I think, listen, the crypto space is a new asset class. And when's the last time we had a new asset class? I mean, it's pretty incredible, right?
Yeah.
So I think, all that stuff deserves a look. I mean, I focus on the equity side of the equation, but where I think that comes into play is when my system gets more defensive. Okay, where else can we go to get actually maybe some positive return, right? During that time, instead of going to cash or just T-bills, right? So yeah, that's where I think some of that stuff can come in, particularly on the gold. You mentioned gold. I think that that's very interesting historically to look at during times of market stress, equity market stress. That often you see pretty good reaction from gold.
So Vinny, sorry about that. I keep hitting the leave the studio instead of stop sharing screen button because I'm old as hell. I wanted to ask you a question to follow up with what we were just talking about with the 70-year-old woman. If I worry about liquidity with people that are older, not necessarily about getting out of risk assets, but liquidity, is that something you take into consideration? Because there's a lot of people in that generation specifically, they're in real estate. And they have this idea that real estate can't go down, which we all live through and we know it can. So I worry about liquidity. Sometimes they end up in a situation They need long-term care. They end up in a home, whatever. And then their kids and their grandkids are stuck with this idea of like, do we sell the 3 houses? Do we sell the land in Arizona? What do we do? And you can't do it quickly. And we all know that there's a certain amount of money that nursing homes specifically will come for prior to using up any of the government benefits for these kind of things. They want to deplete the personal assets first. So when somebody asks you about that, what do you tell them?
Well, I mean, what I would say is that it's always good to have a plan, right? It's always good to be prepared. You know, that's sort of my approach with everything, whether it's risk management or the type of question you asked for. So yeah, I think that makes a lot of sense. And I think it's a totally overlooked point in the market right now. And I don't know if this is indicative of where we are, where we might be in this in the cycle. But this is a little tangent, but it's connected. You know, I was at a conference recently, and it was with financial advisors, and one of the biggest things that they were being sold or pitched was private credit. Like it's this panacea. And I'm thinking to myself, like, there's all sorts of liquidity problems there. You know, yeah, maybe on paper, you know, mark to market returns look okay or whatever, but that's pretend. And liquidity is a need sometimes, right? Yeah. So I think you're totally right. That's something that, to me, that's just starting to become one of those ignored risks.
So I want to touch on something real quick. Luis, can you put up Widge's last comment that starts an elderly person? Because I think Widge may have mistaken what you said, Jimmy. And I want to see if I can answer this, and you tell me if I'm misrepresenting.
Yes, because he might have misrepresented
who wins the game, and you want her to stay in the game. We have very different takes on that one. I don't think Jimmy is saying, so you're at a point where you don't have to worry about how much money you have going forward. Keep 90% in stocks. I don't think Jimmy said that at all. And I think that's might be the way you took it. Jimmy, am I wrong on that?
Yeah, which I was saying at the very maximum 25 to 30% in risk assets just for the 20 to 25 year time horizon in case she lives that long. Because my belief would be 80%, 70% of that portfolio still wins the game. So I was saying a winning strategy with a tail that could help against inflation, help against, you know, stupid things the government might do that might make risk assets go higher, like liquidity injections, et cetera. So I'm not taking I'm not snatching defeat from the jaws of victory. I just think you can win and still take a little bit of risk. I hope that makes sense. And if you disagree, that's perfectly fine too. We've disagreed on things before, but I think winning can be defined differently. Vince, you have anything on that?
No, I think you're exactly right. I mean, I think that it's kind of nuanced, and we don't have enough information there to kind of fully solve out. But
and let's say this is a hypothetical person anyway, because I'm not sure she'd want to be talking to me anyway. That ship's probably sailed. But the reality of it is that I like a game that's been won. That to me makes me happy. I still thought that she could win that game, just forget about the allocation to stocks for a while. And, you know, hopefully in 10 years, she's, you know, made her 9% per year and didn't look at this up 30, down 30. Right?
This is really the issue that this profligate spending has put us in, because if you continue around this path, I saw a study this morning that I'm glad to bring up. I'm glad this came up so I can bring it up, where inflation actually, we're focused too much on the Fed. When you look at the trajectory of fiscal spending, okay, it was basically like this. Then in COVID, it shot up, right? Then we came down a little bit. Now we're still way above what would have been the fiscal spending trend. And that is likely why we have stagnant, or I shouldn't say stagnant, persistent inflation in the system. Yeah. So if you continue to devalue the dollar, if you continue to have inflation, just simply pulling your money out of the game, you might run out because of inflation and because
that's
of the
risky too.
Of the dollar.
Right. Yeah.
That's just
half
as
of the game here is just protecting purchasing power. Everybody looks at the discussions we have and thinks these people are trying to speculate and make money. Hell no.
We don't sell anything.
If you don't participate, you are losing money by the dollars being that are in your pocket being devalued constantly. Half of our game is just trying to protect our purchasing power and not go poor. When
I actually just said something that's not true. We do sell something. We have a newsletter now, but for a long time we didn't sell anything.
We didn't sell something. We do.
You were saying the same shit.
Unfilteredinvestor.com, by the way, and it has been kicking ass.
Yeah, it really has. So Vince, what's your overall theory for compounding versus risk? Can you just kind of go into that real quick?
Yeah. So, I mean, I think when it comes to compounding versus risk, the equation, it just works so much better if you don't take big drawdowns. And I know it's an easy thing to say, but it's not a lot of, it's not a point that a lot of people understand. They just see that average and they're like, oh, that's just extrapolate that average forever and everything's okay. But big drawdowns, you can't ignore them. If you do, they break compounding, right? They basically break it, and protecting against them is, I think, the most powerful thing that you can do, that you actually have control over. We don't have control over the market, but we have control over what we do about what we see, and also our emotions as it relates to that, right?
So I have a question for you then Vince, is that why don't you at your advisory have like a division, like an options expert? Let's call him Jim, for lack of a better name. So instead of selling out when your market breadth signals to you that that we are at a market top, couldn't that be just an opportunity, instead of taking any sort of tax events, to increase your put protection for that time being until you weather the storm? Have you considered that, and is there reasons why you wouldn't do something like that?
I think it's a totally valid point. The way that I'm set up is basically to do the really hard part, which is identify when that is.
Right.
How you react to it, what you do about it, is going to be so dependent upon how you perceive risk, what your situation is. And then, of course, my signals are all graduated. So it's just a third, a third, a third. In other words, we never go like full out, at once. It's just not something we would ever do. But no, it's a totally great, I think it's a great strategy, and one that I suggest to people who have that problem with taxes. And a lot of people do.
Right? Yeah, so I don't like paying taxes. Right. Bobby?
No one likes it. Yeah.
Yeah, I want to put up Tim's question if I could. And I actually have a short answer, but I want to give it to Vince first. Tim says, does Vince have any thoughts on bank preferred stocks? I love them, but other than Chris Whalen, who, God, I would love to get him on the show, but he's difficult
Tim,
to get
I want to talk to you more about preferreds. I've been looking at preferreds a lot. So McLean, I'm going to get in touch with you and we're going to cross notes. But anyway.
Yeah. So I mean, other than Chris Whalen, nobody follows them. Yields of 6 to 8%. Vince, you got an opinion on that?
What's fascinating about preferreds is that they have so much, equity-like behaviors. To the extent that if you look at the all issues, what I call the all issues against the client line, it includes preferred stocks, which really, sometimes act like bonds, but mostly act like stocks. That tells you a lot about liquidity, right? And I think when you have the wind at your back, that's just another risk asset. And if you're getting paid, 6 to 8%, and you can still use something like, my risk management tool to manage that risk, then that's probably pretty interesting. Yeah.
Let's kick ass. So Bobby, here's my thesis, and then I know you have something in your head, but what about just the 5 biggest banks buying the preferred, and B of A, JP, Goldman? They're not going to go broke again. The government has already said they have a government backstop, correct? So why not just take your 6% on those? You got it?
Well, Janet Yellen said they may not, but I guess they fall into the ones that do. There's 2 main negatives to me to bank preferreds, and I do own some, by the way. So I'm just putting these negatives out there. And I know that Tim was one of the people, because I have a personal relationship with Tim, Vince, just so you know. And he reached out to me. He said, I think the 10 years is going to rip. We don't have to go into why. If the 10 years is going to rip, you don't want bank preferreds. I mean, the interest rate risk is the risk. Right.
I mean, yield rip higher is what you meant.
Yield rip higher. And we always talk in yields, Tim and I do. So
I'm starting to talk more in yields than in prices too. I'm tired of being a bond.
I've always thought the CME did that wrong. They shouldn't have been priced for a long time. They finally came out with a yield contract, and it's gotten very popular. But if you think yields are going to rip, which he expressed to me thought they were going to, I don't want bank preferreds. The second thing is, if yields go dramatically lower, banks can call them in, and generally at par, which may be lower than you paid. So those are the 2 risks of them. Now, I'm not saying that those are the risks and the reason I'm out of them. I'm in some. I own some bank preferreds, but it's not my main holding because I am a price change guy. I do look at dividend yields when I'm down on a stock. I'm like, oh, well, we're
at least it pays me 2.5%.
That's really me copping out of the fact that I picked the wrong share. So, but I just want to throw those things out there. There's a lot of other things like changes in regulatory structure and things but those are more obscure. So,
Vince, do you cook?
I do. I do.
Yeah, I bet you do. Because I have this buddy of mine who's very, very Greek, from a Greek neighborhood. And we always say, I tell him that I think Greek men and Italian men, of the Greek and Italian descent, are so similar, except for one stark thing, is that the Greeks think the women belong in the kitchen making them food, and the Italian men think it's my kitchen, get out, I'm cooking here. Do you agree with that assessment?
I 100% agree.
And Bobby, I told you this. We revisited. We'd stopped it since like the 70s or 80s, but the Feast of the Seven Fishes the night before Christmas.
Yeah.
And me and like 4 of my brothers like competed. Like I did a smoked salmon on the smoker, and I did a shrimp scampi. My other brother stuffed the branzino, did a zuppa de pesce. It was one of the best parties ever. We even had some of the Merigones come in. By the way, did you guys use that expression when you were kids, Merigones?
Yes.
And
we said Americans, which is the actual Italian.
We say Merigones. And for you people who are out there going, what is he talking about? Italian, the real tight-knit Italian community.
What's an Amerigone? I don't know.
It was a bastardization of the Americans, and that just meant
it's American.
But we invite some of the Merigones. And by the way, different parts of Italy have different dialects.
Stop saying it wrong. You drive me crazy.
You're saying it wrong.
No, I'm saying it in Italian.
Ring that bell again. We're going to fight again.
I have the fortunate situation of my mom's birthday being Christmas Eve. So that 7 fishes has gone on as long as I've been alive, every single Christmas Eve. Yeah, she wants to do it, and it's her birthday, and she gets what she wants.
I love that. I love that. Do you do a piece of 7 fishes, Vince?
Yeah, we do it. We still do it down here. I mean, we don't really have much family in the area. Just my brother lives down here, his wife, but the rest of my family's up in New Jersey still. But yeah, we still do it, and it's at my house.
Oh, it's fantastic.
Awesome.
And you're in Florida, so you get some good fresh fish too. So
we do. We do.
My mom's 82, so when the unfortunate event happens and she's not around, I don't know if it's continuing back in Chicago. So you may have a visitor. And my wife makes my mom's zuppa de pesce. You can take that off your list of things to do, unless somebody's going to fight my wife for it, because my wife does a good job of it. That's nice. I want to ask you real quick. You talked about your tool. How do people get a hold of you? We have RIAs and investment advisors that listen to this show. How do people get a hold of you if they need to, or if they want to follow up more on what you actually do?
Yeah, my site is viewright.ai. And of course, I'm on LinkedIn. On X, I am CMT Randazzo. So yeah, I would love to get in touch with any listeners that you have there who would be interested in.
Who's your ideal customer? Who's your normal customer?
RIAs are my best customer and most common customer. They just are more independent in terms of the way they think, and also their ability to be a little more tactical and be a little more creative.
And is your role with them advisory, or does the money actually go under your umbrella of management?
No, the money stays with them. They're in full control. I just give them the signals to make it easy. These guys, they just don't have the time or the bandwidth to be tactical. But I think we're coming to a point, sometime in the next 5 years or so, where it's going to be really important to be tactical again. Everyone thinks that can't happen again, but history tells us that.
Do you have any decent net worth just individuals who are your clients as well?
We don't, market toward individuals. Individuals often do come to us, but it's not something that we are really targeting in any kind of way. It's really advisors that we're targeting. That's who we're speaking to. When we write the reports, that's what it's sort of aimed at. Yeah.
Can I just point out something funny real quick? It's not a question.
We'll decide if it's funny or not. You tell us.
Okay, fair enough. So somebody called Altcoin Daily on Twitter, which I don't follow him. I don't know why it popped up here. Maybe I do follow him. Doesn't matter. He put up before the NVIDIA earnings, if NVIDIA misses earnings, crypto is done. And I just glanced at Bitcoin. It's up 1/3%. So I don't know where that's coming from. Also, NVIDIA is only down 3.41% now. So there's clearly been some buying.
Kenny Polcari might be right. Yeah.
As he often is.
He often is. It's funny because he always expresses what he thinks in the moment, and he's frustrated with the moment, and then you give it like 24 hours and he ended up being right.
Yeah,
right.
No, I agree. Yep. All right, so we already told everyone where you can find Vince. I am very, very interested, so I'm going to go. Give me the website one more time because I will definitely go on it.
Yeah, it's viewright.ai.
Viewright.ai. Yeah. Perfect. Okay. Thank you guys always for joining us. We really, really appreciate it. We love the interaction of this show. Remember Bobby and I's story? We were in legacy media for 25 years each. There, you're always at the whim of some overzealous producer or a sponsor telling you what you can and can't say. Our opinions might be wrong and stupid, but at least they're our own opinions and they're not being formed by anyone else. This is the Trader's Edge. I'm Jim Iuorio. That's Bob Iaccino. That's Vince Randazzo.
Thanks.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.